Hey, market chameleons. Thanks for joining us for another episode of the pre-market show with Dmitry and myself, Will McBride. How you doing, Dima?
Good morning, Will. Good morning, everybody. Thanks for joining us. So, Will, you want to
Yeah,
do the...
we'll start with the disclaimer, of course. Hold
Okay.
on.
And while Will's putting it up, everyone keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, then contact your registered investment advisor or call your broker. They should be able to help you answer any of your questions. There's the disclaimer.
Excellent. Before we get started, anyone on YouTube Live, put your questions in the chat for Dmitry this morning. We'll try to get to as many as we can. And I'm also putting the link right now in that chat to the Zoom meeting. We process this through Zoom. So if you have a little bit of a fuzzy picture on YouTube, you can always come over to the Zoom. And with that, Dima, let's get started with the pre-market. What's going on?
Okay. Yeah. So what I think we'll do today is we'll cover some of the pre-market movers. I think we also we'll take a look at one of the trade card ideas, because we started out yesterday right at the end of the show and we didn't fully go through one. So maybe I'll concentrate on one of those today just to walk through an example and walk through the statistics of it. Also, just keep in mind, I think the Fed's talking today. I don't think there's anything. They're not expected to make any changes here, but maybe we'll get some insight from the Fed and what they think about the economy. Right now, let's start out with the pre-market report as usual. You know, these are stocks that are trading in a pre-market hours. We got the most active stocks. We got the biggest percentage gainers, biggest percentage decliners. I'm going to take a quick look to see what's going on in the higher market cap stocks. So let's filter out for stocks 50 billion market share or higher. So we see here got 12 on the gainers list versus 5 on the decliners list. Making top of the list, FedEx. They had earnings yesterday?
They did have earnings.
Yeah, so I think we were talking about the FedEx earnings before and how they might be benefiting from, you know, people staying at home and making a lot of purchases online. And I think what's that, UPS probably up in sympathy with it. So not as many as yesterday on that big gainers list. A little bit more evened out today. That's in the higher market cap stocks. Let's go to the unfiltered report. So in the unfiltered report, we got KODK up again. You know, that's been a high flyer a lot of times. So up 48.5% on 16.5 million shares in the pre-market hours. I guess there's news on that. MYO, I think that's a healthcare stock that's up 40% in the pre-market hours on 2.7 million shares. Let's go, as an example, we'll take a look at KODK and maybe MYO before we move on. So let's take a look, KODK, how this stock, we'll first take a look at what's going on in the pre-market trading. Then we'll take a look at how this stock tended to perform after having a big upside move in the morning. So here we see KODK closed $6.23 yesterday. Today in the pre-market hours, it's trading $9.42. That's up 51% from yesterday's close. The range in the pre-market, $7.17 to $10.96. VWAP price $9.23. So trading a little bit above the VWAP price on 16.7 million shares. Longest VWAP bar right now I see $8.79 to $9.06 on 4.6 million shares. This is what the stock chart looks like in a pre-market. So really big gap move up right here, probably when the news hit, and it's settling down a little bit from that high up here, which was above $10. There is some news here. I'm not going to get into it, but I do see that there's some news hitting the wires today around 8 a.m. Let's take a look from a historical perspective how the stock behaved after opening up, making a really large opening move to the upside. So this, in the last 3 years, we're looking at the 12 largest opening gap moves These are the dates, any notes over here. So if there are press releases on that date, you could kind of hover over there or see what's going on. And these are the opening gap percentage moves on those dates. So we see on average, 12 largest gap moves up 53%. That's the average, and you see that there's a wide range, you know, as low as 6.9%, 271% on some news. So really big gap moves historically, and we've seen those actually and talked about them before. So what happens what tended to happen after a very large gap move to the upside, from the open to the high of the day, the average move was up 23%. We've seen a couple of them where that gap move to the upside was the high of the day and just went lower. From the open to the low of the day, the average move was down 14.8%. From the open to the close of the day, it tended to drift lower more often than higher. 92% of the time, it closed lower from that opening price, 8% higher for an average loss of 3.4%. But we do see, like here, this really one big move to the upside after opening up 139% on July 29th. It gained another 74% by the end of the day. So very volatile. Let's take a look. On average, the move in either direction from the opening to the close of the day, 15.8%. So very volatile after the opening, you know, average move 15.8% in either direction with a high move 74.7% right here. So that's a quick historical return distribution after the opening in KODK. Let's take a look at MYO before we move on. Here's another stock that's up big in the morning, closed $3.82 in the healthcare medical devices. We see it traded, it's up 38.2% in the pre-market with a VWAP price of $5.42. Its pre-market range is $5 to $6.39. This stock was as high as $40. It's 52-week high. In the pre-market, trading 2.8 million shares. That's compared to a float of 3.6 million. So on a relative basis, that's a lot of volume in this MYO. Looks like it had some news here. I'm not going to get into it. You know, I'll let you guys read it and figure that out. This is what the chart looks like in the pre-market hours. Longest VWAP bar, $5.33 to $5.43 on 869,000 shares. Let's take a look at this stock from a historical perspective. What did it tend to do historically after opening up, having a big opening gap move to the upside? So again, last 3 years, these are the 12 largest gap moves to the upside. These are the dates. Here are the percentage moves at the open. So on average, the average move at the open was 36.2%. That's the average gap move compared to today's 38. So really right around that average. This is what it tended to do after the opening. So the average move from the opening to the high of the day was 40.8%. Again, see these zeros. That means that a lot of times, actually 33% of the time, that opening price was the high of the day and it drifted lower. From the open to the low of the day, the average move was 18%. From the open to the close of the day, it tended to go lower more often than higher. So the closing price was lower 83% of the time. From the opening price, 17% of the time higher for an average of negative 5.1%. As far as volatility goes, from the open to the close of the day, the average move up or down 20.7%. So very, very volatile. Again, this is a low cap stock, you know, very not a lot of shares out there outstanding, not a big float. So that's very, very volatile stock. So let's actually move on from here. Let's take a look at any upcoming earnings, unless you have questions on the pre-market report specifically, Will. I'm going to move on to to earnings, and then let's go over a trade card.
All right, move on, my friend.
Okay. Actually, you know what? Before we even move on to the earnings, let's take a look at the stock order imbalance report yesterday. So these are market on close order imbalances day by day. This is September 15th yesterday. So we have, you know, a 5-day history here. Let's just take a look how those order imbalances from day to day have been changing. So we see September 9th, we had on the buy side $1.1 billion worth of notional buy order imbalances versus $1 billion in notional sell order imbalances. So kind of even there. September 10th, $342 million on the buy side versus $1.1 billion on the sell side. So more weighted much more on the sell side. September 10th looks like September 11th, it kind of jumped back to the buy side, $1.2 billion to the buy side versus 651 on the sell side. Then it started evening out yesterday, September 4th, 1.4 billion on the buy side versus 1.1 billion on the sell side. Yesterday, almost even as well, 759 billion on the buy side versus 893 million on the sell side. So just looking at those order imbalances, it looks like now it's kind of starting to even out. Maybe we're looking at a shorter term or more fairly priced market, at least if we were just taking a look from the perspective of this report. Let's take a look then at the upcoming earnings analysis. Let's just see what's coming up in the earnings in the next 2 weeks and see what the option prices are predicting the magnitude of the move. So I'm going to filter this out by stocks that trade at least 5,000 option contracts or more on average per day. And I'm going to go to this full report next 2 weeks. So we see Nike, September 22nd, expected to report September 22nd after the market close. Right now, it's looking at the straddle. It's predicting 8.3% move in either direction, but we are kind of far away. So nothing coming up actually this week. Not a big list here. So to leave more time for the trade card, I'm just going to move over. Skip this one today unless you have specific questions on earnings, Will, and kind of continue on that example we were doing.
Well, yeah, with the example, we did have a question. Someone wanted to walk through basically a trade card in SPY. Okay. If they have a bearish view, they were asking, how do they look for an opportunity?
Okay, so over here, I'm going to go to the SPY screen, and let's take a look at the trade ideas here. So when you're on the trade ideas, these cards, they're being generated from our screeners. So it's looking at the preset filters that we set, and anything that gets filtered out based on our presets, it will generate these cards. So if you do a drop down here, you could pick, these. It's defaulted top 3 by edge, so it's not having any specific outlook. It's just looking at historical data and calculating, odds of success and theoretical values. But you can switch by win rate, bull call spread, bear call spread. So you have, these choices, and I think we will be adding some more down the road. But like, say you want a bear call spread over here, you could just click on it. So it'll produce you. These are the bear call spreads. So more of a bearish outlook using vertical call spreads. You could do bear put spread, debit spread, and just switch it like that really quickly. So on the bear call spread here, you have, this is using yesterday's closing prices. Today we're not open yet. So yesterday's prices, it's filtering out vertical spreads. So in this situation, it's looking at September 16th, which is expiring today, using selling the 341 call, buying the 343 call. That credit was 72 cents. We think it's worth 55 cents. That's a 13.6% theoretical edge with a historical win rate of 70%. So again, these will be recalculating, after the market opens Someone did ask me a question yesterday because they were looking at these, for example, these trade cards, and they'll say, well, I looked at the trade card, but then I refreshed and it was gone, or these changed, right? So the win rate changed, the theoretical edge change, and the question was, well, why did it disappear? So one of the things to keep in mind is that our markets are continuously trading, right? There's continuous trading in the markets, and data is continuously trading. So this takes a snapshot at one moment in time, crunches the number, and produces it. So as things change, you refresh it, and it'll recalculate everything based on the new information. So what does that mean? Why are they? Give me an example. So if you guys ever see, well, have you ever seen where people play poker on TV, and the players, in the beginning, they each get two cards facing down, right? So nobody sees what the cards are. Every player at the table gets two cards facing down, and then the dealer flips over the first card. Everybody sees it, and let's say it's a 3.
Yep.
So then you see people are they'll say, oh, well, player A, one of his cards is a 3 facing down. Everybody else has nothing. So player A has like a 60% advantage, right? Based on that information. So then the dealer will flip another card. Now there's new information. And let's say it's a 5. Oh, well, player B has a 5. So player B has 2 5 at this stage. Player B has 2 5s. Player A has 2 3s. So now player B all of a sudden has the bigger advantage. So as things are changing, the odds, everything is changing, right? It's dynamic. So keep in mind, our markets are continuously changing. Data is continuously changing. So of course, these will always update based on that at that moment in time. Does that make sense?
It does. Mike from Tyler, Texas is asking, are those updated every 15 minutes?
So the data itself, remember MarketChameleon, the data itself, it's on a 15-minute delay. Then these cards are run on a timer. So like, depending how busy the product is, between 5 minutes to 15 minutes on a timer. Like if the stock trades 0 options and there's no trading or no open interest, then the timers are longer. But on the busier ones, it will crunch the numbers, get the new data, and every 5 minutes it will recrunch the numbers. So that's how it is. That's how it works, because I do get questions. Well, why are these changing? Markets are dynamic; they're continuously changing, so we're recrunching them. Let's take a look at the credit iron condor. So this is the first card up here. So we could go through this example here. And this is what it's saying, that based on yesterday's closing prices, it's looking at this credit iron condor. It's selling the 340 put, buying the 333 put in September 18th. Also selling the 340 call, buying the 347 call September 18th, all in the same expiration. So what it's doing, right, selling the at the money, buying the wings for protection. That's why it's a butterfly. In it, and we see here that it's a $7 butterfly, right? So the difference between 340, 333, 7, 340, 347, $7. So maximum it'll be worth is $7 at expiration. Right now, the credit is $4.70. So I guess the question then becomes, well, if I'm selling it for $4.70, I know I have 2 days or 3 days till expiration, counting today. How often does the stock close or move far away, that it'll be worth more than $4.70, or how often does it trade within, right? Because we really don't know for sure what's going to happen in the future until it happens, right? Like it's like a football game. We don't know if team A or team B is going to win, but what we do is create a handicap. Well, if team A has a record of like 10-0 and team B has a record of 0-10, so team A is much better. So you're creating handicaps using your data. So the question here is, well, is 470 a good price or not a good price? So we take our historical data and say, well, historically, based on, a 3-day move, what is the average percentage move? And based on that, let's convert it to a theoretical value. So on average, using 6 years of data, the average end value would have been $3.10. This is compared to today's $4.70, where you would be selling it for credit. The next question is, well, how often, did the end value of that spread, was it below 470, which would have resulted in a profit for you? And that was historically 73% of the time. So does that make sense to everybody? Hopefully, I had to go through pretty quickly, but we'll get a little bit into it here. Let's click on this report and take a look at the payout diagram. So here's the payout diagram, what it would look like. So here, if it closes right at 470, that's your sweet, if it closes right at 340, that's your sweet spot, because theoretically all the options are worthless. They all go away and you keep that $4.70 credit. If it moves away from it, then you start losing, then it becomes more valuable. You have to buy back until it really breaks through, and these are your max losses here at the wings. So that's what a butterfly looks like. And I think we did a butterfly yesterday. That's why I kind of stuck to that butterfly. So let's take a look at the stock analysis. So here it's saying that our break-even points are to the downside if it moves from here down 1.5%. Beyond that, we start losing. Our break-even to the upside is up 1.3%. Above that, we start losing. So anything within that range is profitable to us. Okay, so if it to the downside, if it moves less than, not more than negative 1.5%, less than that, it's profitable. To the upside, it has to go up, but not as less than 1.3%. It's profitable to us. So here's the historical average moves, using 3-day hold period in SPY for using 6 years of data. So here, the average move to the downside over a 3-day hold period is negative 1.3%, which would be within this, right? The average move to the upside is 1.1% on FC, which would be within this. Does that make sense to everybody? So you're using historical data to see how calculate our odds. Hopefully this makes sense. Let me know if you're getting questions. So I'll give you guys, Will, you there?
Yeah, I'm listening. Everyone's good right now. No questions. I mean, the questions coming in are actually, we've had a few questions. People would like you to go back to the Nike earnings and see if there's anything popping up either in the trading cards for earnings opportunities or anything you see maybe around the earnings in Nike. We've had like 3 questions about it.
Okay. So, I mean, I could just move on to that then, Nike, if there's no questions here, or if anybody, if they want, I could finish this analysis or just move on to Nike because we got like 10 minutes left.
I would finish the analysis and maybe hit Nike at the end.
Okay. So let's that's using this historical data. So let's take a look at here. I'm going to click on this options chain over here. It's going to take me to the options chain. It's going to pre-populate those legs, and we'll take a further look at the analysis. Now, remember, one of your outlooks is that there's not going to be a big move in SPY, right? That's the outlook based on the butterfly. It's not bullish, bearish. It's just that there's not going to be a big move in SPY from now till expiration. So again, here's what it looks like. This is what the butterfly looks like at expiration. That's 340 is your sweet spot. Let's take a look at, this is the credit you would receive. This is the market, 470, 476, 473 is the midpoint. Remember, we always say, try to get as close to the midpoint as possible. And we're further from the midpoint, that's like your fee to the market makers. Here, let's take a look at the distribution. So this is the theoretical values here based on 4 years of data. Let's take it up to 6 years of data. I'm going to refresh it. So based on 3 years of data, the end value of this spread is $3.10. Right now it's 470 bid, 476 ask. So if you're selling at 470, that's selling at $1.60 above that theoretical value or average end value. 73.2% of the time, the end value would have been below 470, resulting in a profit. What we could also do is maybe even narrow down our data, right? So that's using all the data sets. So there's about 530 observations. And what we notice here is, well, right now the implied volatility is around 20. So I'm going to take these implied 30 IV, I'm going to increase this range to start, let's say start at 16, narrow this down to below 24. So let me see what that looks like. So if I do that right now, 86 observations. So what I did was narrow down where the 30 IV was between 16.4 and 24 historically. So now that theoretical value is $4.66 instead of $3.10. See, guys, what I did? And the win rate drops to 44.2. So now I'm looking at a smaller subset of the historical data, which changes those theoretical values. So think of it this way: it's like an insurance company. They might say, if I insured everybody, you know, on average, what is my payout on an insurance policy? You know, so let's say it's, you know, $1,000 a person per year. But what if I narrowed down my data and said, well, what about if I took a subset of that and just looked at, you know, 16-year-olds that just got their license the first year? That could be maybe $2,000, right? Because less experience, maybe they're more reckless, less fearless. So that's what I'm doing here, is narrowing down my data set based on certain criteria that I want to take a look at. In this case, it's the 30 IV. Hopefully that makes sense to everybody what I just did. I'll move on to the Nike if there's no questions.
Sounds good. You've got about 7 minutes, my friend.
All right. So Nike, that's September 22nd after the market close. Let's take a look at historical, from a historical perspective. So here's Nike. These are, so let's first look at the historical moves, then we're going to take a look at the implied volatility. And here, these bars, this is showing us what the implied move was up or down based on the straddle prior to reporting earnings. The red, this big red bar, that's the actual move to the downside. The green move, that's the actual move when it was to the upside. So the one I'm hovering over right now, we see March 24th, Nike reported after the market closed. The actual, after reporting earnings, the actual move the next day was up 9.2%. The implied move, according to the straddle, was up or down 11.6%. So you can see that that straddle was on that day was overpricing the actual move. So in this situation, you see where the actual move went way above what the implied move was. So on June 28th, 2018, Nike reported earnings after the market closed. The next day was up 11.1%. The implied move in either direction was up or down 4.7%. So that busted through the straddle. Let's see historically, the historical statistics. So we see that the options market over here overestimated the move 69% of the time. So 69% of the time, the straddle was priced higher than the actual move. The average of all the implied moves was up or down 5.6%. The average of the actual moves in the stock the next day was 4.9%. So we see about a 0.7% differential on average between the implied and the historical average move. Let's take a look now at the implied volatility. And that's why you see long straddle was a winner 44% of the time for an average loss of 12%. If you just kept buying the straddle day before and selling day after in the last 12 quarters, doing it over and over and over again. Let's take a look at the implied volatility crush here. So this is looking at what the implied volatility did, what the Vega did the day after earnings. Now, it's not looking at the front month straddle. It's looking at a straddle that's 30 trading days out, 30 trading days to go to expiration. So remember, the front month is really where you're playing the move. If you're looking at the implied volatility in the Vega, you're going out further out because that's where you're getting the implied volatility. That's where the Vega is higher, right? So 30 days out, and this is where people are playing calendar spreads, hedging the move in the front month, selling the Vega in the out month. So on average, 30 days out, the implied volatility the day after earnings was down 27%. 1 day before earnings, the average implied volatility was 35.9. Day after earnings, the average implied volatility was 27. 5 days later, it looks like it continued to decrease. The average implied volatility on that 30-day constant maturity, 24.6. So we're still, we're still far away. We got like a week to go to the next earnings. So as we get closer, we'll take a look at where those implied volatilities start lining up. So we still have, got like, I don't know, at least a week to get there. So that's really quickly the perspective of the Nike earnings analysis. If you have any last questions, well, we're heading right up against the bell.
Awesome job, Dima. As always, great. Listen, chameleons, a lot of good chat there this morning. Please, a thumbs up for all you new chameleons. That always is helpful for YouTube. And remember to subscribe to the channel. You get alerted to any of the big new releases that Dmitry puts out there. A lot of good video content. I think we have almost 400 videos now on YouTube.
Oh, awesome. All right. Thanks, everybody, for joining us and watching. Really appreciate the questions and the feedback. Hope to see you guys tomorrow. Have a great trading day.
Have a safe trading day, everyone.